Hey everyone, John Henry here, Slingshot Futures Trading Group. Thanks for joining me in today's video. Before we start, take a second to give the video a like, subscribe to the channel, and make sure to click the notification bell icon so you don't miss our next live stream or next video launch here on YouTube every day. Make sure you start your day off the right way. Don't forget your free morning brief that's waiting for you at ssftg.com/brief. In the top left, you can click on Morning Brief to jump into that. That's where you'll find all of our major DP levels right up here at the top, as well as a quick technical overview for the major 6 markets that we look at. The NASDAQ, the S&P, you've got gold, crude oil, the euro, as well as Bitcoin. Maybe you're looking to get a full game plan for the day, week, or month. Check out the join button below. Level 1 subs get a brand new members only video every single morning going over the major 6 markets and a game plan for the day. In addition to that, once a week I launch a weekly brief, and of course once a month we have our monthly brief as well. Of course, all members gain access to our private Discord chat server, and if you really want to get into the nitty-gritty, check out the live analysis room for level 2 subs, where you can see my screens in real time during the New York Stock Exchange Open. You can ask questions and interact with the other members, as well as bounce ideas off myself and everyone else. It's a fantastic environment, and I would love to see you in there. Alright, and now on to the really fun stuff, the topic for today.
Patience while trading. When it comes to day trading, it's this weird game of balance between being patient and being impatient. We have to be patient when the time is right, letting winners run, and we also have to quickly flip and switch to impatience when a trade is going sour. This is by no means an easy thing to learn. Even the best traders in the world fumble from day to day. We make mistakes. We push the wrong buttons. We hit the wrong things. We're humans. We have this kind of innate ability to really overcomplicate things sometimes, and we're really good at it. And that's why it's so important to have a plan of action for your trade. When we know exactly where a trade is supposed to go or what we want to see out of a trade, then we know exactly what makes the trade a go or what makes the trade a no-go. Everything is all spelled out. Where are the areas to remain patient? Where are the areas that I'm going to lose patience quickly when the market's not doing what I want it to be doing? And then what makes it even more of a moving target is that each day is different, right? Different news events, global events, holidays, Twitter posts, a little bit less of those, but that rock and roll moves the market all over the place. It's like a roller coaster. So how in the world do we gauge where we're supposed to be patient and where we're supposed to lose patience? First, it comes down to having an outline for what we expect the trade to do. This is the framework. It's our expectation. We need to create a worst case example or a worst case scenario and a best case one so that we know what it might look like while it's still okay, but kind of gross, but also what it's going to look like if it's picture perfect. That way we've got all sides laid out. So this would be a really good example where if I'm looking for a long on the NASDAQ that's setting up right this second, there are a few ways that I'm going to approach this. When I'm looking at this type of move, I'm visualizing exactly what I would like to see this do. Obviously, of course, I would like to just see it do this. Just go straight up and we'll be a happy camper. But we have to be realistic too. When I'm looking at a move like this, I expect to see a little bit of ebb and flow, a little bit of back and forth. That's how markets operate. So if I'm looking for this zone, this L2 in this case, just because it's on my screen, to act as a zone of support, if I want to be a buyer here, then I want to see this area act as support. Give me higher lows, give me higher highs, something like that, where, it's okay if we're grinding around the break-even point because I've spelled out what is okay, what is acceptable for the trade. It can move around here, that's fine. Best case scenario, obviously, it just pings right off the top of it and we don't take any heat and it just goes screaming up. That almost never happens. But then there's also the worst case. What if it doesn't work out as nicely? Where could it go? I'd be okay if it dipped down, maybe a little bit underneath those lows, but if it starts getting much further than that, that's kind of my break point. And right there, I've already qualified what is me losing impatience, or I guess me gaining impatience, however you want to word that. If the market's not doing what I want it to do and it's breaking through those areas of support, it's no longer doing what I expected it to do. I wanted to buy it as an aggressive buyer buying an initial pullback. In this case, it was a TUL2. If I want to buy a TUL2, I expect that to do something very specific because that's how my trade plan works. I know what to expect with this type of setup. And if it's not doing that, then I have every reason in the world to not want to stick around anymore because, well, it's not following the rules of what I want to see. And within that lies one of the hardest parts of the whole thing. How do I remain patient? So if the market is doing what I expect it to be doing, I didn't take this setup, but let's say as an example I did. If I were long inside here and I wanted to be a buyer and I were long for whatever reason, I had a nice bull bar, I don't care. And we're buying into the move, what I expect to see is that we shouldn't break much below those lows. So far, the market has responded quite nicely. But that also means that it can still pull back down here. That's fine. It's acceptable because it hasn't broken structurally what I would deem necessary to qualify the trade in the way that I want to see it. So as long as that groundwork stays stable, then I have a reason for the trade. Now, I do have a few breakpoints, and I think everybody should. As an example, if I'm taking a scalp trade long, I'm willing to let the market come back against me once, right? I'll give it a little bit because it's the market. It has to ebb and flow, but it's a scalp. I'm not planning on staying in there for very long, a couple seconds, maybe a couple minutes. I don't want to give it a whole lot of time. But if it wants to pull back once, okay, fine, I'll accept that. But it's got to go back after that. When I'm looking at a swing trade is inherently a longer term trade. It's something that even on an intraday perspective, a swing trade could still be 20, 30, 40 minutes. Well, if that's the case and that is a longer term trade, then you've just got to approach it from that mentality or that time frame. But everything else falls in line with exactly where you would expect it to fall. So then for a longer term trade, I give it a little bit more time. I'll allow the market to come back against me twice. The first time it pulls back is when all of the traders who missed the initial entry are able to jump back in and support the market back up. That's that first pullback. I didn't expect the trade to be successful. I'm taking it as a swing trade. Swing trade typically means high reward, low risk. Well, if it's low risk and high reward, something's got to be a trade-off. That's going to be the probability. So the probability isn't good in the first place. I expect that going into the trade, right? I already knew that given the risk reward. So I'll allow the market to come back against me once, go up for a scalp. For a swing trade, I'll let it come back again, but that next time, that's the make or break. It's got to bounce there and go, and I don't want it to come back again after it goes again, because that's where things fall apart. It shouldn't be coming back that many times, right? It might come back once, maybe twice, sure, but 3, 4, 5 times, that's just too, it's not working at that point. Something's wrong, and that's where, again, I become more impatient. It's not doing what I want to see, so I become impatient with a trade, and I'm getting ready to kick it to the side if it doesn't want to follow through with what I want it to do. So realistically, what it all comes down to is, as long as you have a plan of action for your trade, whether it's a certain setup or an indicator or a Heikin-Ashi candle or whatever your favorite method of using is, as long as it's following through with what you expect it to do or what it should be doing, then there's no reason to become impatient, right? It's doing what you expect it to do within a reasonable boundary, right? It is the market. It's not perfect. Got to give a little wiggle room. That's why there's stops with space. But you got to give it a little wiggle room. As long as it's following with inside of that, though, it's okay. But as soon as that starts invalidating, cut it off. That's when it needs to get axed or quickly converted into a different type of trade where you're looking to mitigate risk by building in or whatever you need to do, whatever your trading plan is. But when it's not doing what it was supposed to do, time to start shifting things up a little bit and potentially even exiting. But that's going to do it for this one. Hopefully you found it useful, interesting, entertaining. As per the usual, like we always say, stay safe out there, keep those stops in play, let the winners run. Till the next time, we'll see y'all then. Thanks.